The first time you hold your own car keys, it doesn't feel like debt. It feels like freedom. Cold metal in your palm, the little key fob blinking like a heartbeat in the dark parking lot, your breath turning to fog as you press unlock, and the lights wink back. But a few weeks later, that same key fob is sitting on your desk while your phone buzzes with a payment reminder, then an insurance bill, then a message about your interest rate. And suddenly, the car isn't a car anymore. It's a monthly subscription to being allowed to move. This is why it sucks to finance a first vehicle. Not because young people are careless, not because you should have known better. It sucks because the first car sits right where you're most vulnerable. Low cash, thin credit, high emotion, and a system designed to turn "I need a ride" into "I'll be paying for this version of myself for years." In a moment, I'll show you the quiet trap most people don't see until they're already inside it, the part that makes a reasonable decision feel like a slow leak in your bank account. Picture the scene. A teen or a young adult, maybe you, maybe someone you love. You're not trying to flex, you're trying to get to work without begging for rides. You're trying to get to school. You're trying to stop feeling like life is happening somewhere else, and you're stuck at home watching it through a window. And the car becomes the bridge. The bridge to a job that starts early, the bridge to independence, the bridge to being a person with options. The problem is, the bridge is sold like a destination. You walk into a dealership or you scroll listings late at night and you start thinking in monthly payments instead of total cost. That's not a personal flaw, that's human. Monthly is how rent works. Monthly is how streaming works. Monthly is how everything works now. So when someone says, "We can get you into this for just a little each month," your brain relaxes. The number feels manageable. The story feels safe. This is the part nobody says out loud. The monthly payment is a magic trick. Not because it's fake, because it hides what matters. A long loan term can make almost any car look affordable on paper, the same way cutting a pizza into smaller slices makes it feel like you didn't eat much. Same pizza, different illusion. And the system has reasons to push you there. Banks, credit unions, and car makers' finance companies all compete to write auto loans, and the market shifts based on rates, incentives, and risk. In recent Experian reporting, banks held roughly the mid-20% share of auto financing in early 2025, with captives and credit unions also taking large slices of the pie. That matters because these are not charities. They're not villains either. They're businesses. Their job is to turn your need into a contract. Now add the first-time buyer reality. Young drivers often have little or no credit history. Sometimes they're under 18 and can't sign a binding loan contract in many states, so a parent steps in. Sometimes they're 18, 19, 20, legally able to sign, but financially invisible to lenders. That's where the co-signer enters like a supporting actor who becomes the main character. And co-signing can be loving. It can also be risky, because the loan doesn't care who's driving the car. It cares who signed the paper. So the deal gets done, you drive off, the key fob in your pocket feels like a passport. Then real life starts sending invoices. According to LendingTree's 2025 roundup, the average monthly payment in the third quarter of 2025 was about $748 for a new car and about $532 for a used car. That's not your payment, but it's the weather system you're driving in. And if you're young, those numbers can feel like a storm. Here's the quiet trap. Your first financed car often costs the most when you can afford it the least, because the payment isn't the whole payment. Insurance is the shadow payment. For new drivers, insurance can be brutally expensive, especially in certain states and cities. Maintenance is the surprise payment. Gas is the drip payment. Registration is the annual ambush. And if you bought used, which is often the smartest first move, the repairs can arrive like plot twists. And all of it stacks on top of the loan. The loan itself has its own gravity. Interest rates moved up sharply after the era of ultra-cheap money. Edmunds reported that in the first quarter of 2024, average APRs were around 7.1% for new car loans and 11.7% for used car loans. Again, not your exact rate, but it tells you something. Borrowing got more expensive, and used cars, where first-time buyers often land, can be even pricier to finance. So the first car loan starts to feel like carrying a backpack that gets heavier the longer you wear it. Now, let me tell you a short story. Not the famous kind, not the internet parable, just a quiet one. A kid named Maya, let's call her that, gets her first job across town. The bus exists, technically, but it's 2 transfers and a mile walk. She's late twice in the first month. Her manager doesn't care about transit schedules. He cares about the clock. Maya finds an older car that looks clean in photos. The payment fits her paycheck if she just works a few extra shifts. Her mom co-signs because she wants her daughter to be safe and independent. Maya drives home that night with music low, hands tight on the wheel, key fob glowing on the passenger seat like a tiny trophy. 2 months later, the car needs brakes. The shop quote is bigger than Maya's savings, so she puts it on a credit card. Now she has a car payment and a card payment. This is how it escalates, not with one catastrophic mistake, with a sequence of small, understandable decisions. Now, the second scenario. A guy named Jordan is 19 and determined to do it alone. No cosigner. He gets approved, but the rate is higher. The lender isn't being cruel, they're pricing uncertainty. Jordan takes a longer term to keep the monthly number low. At first, it feels like winning. But the car depreciates faster than the loan balance falls. The value drops, but the debt doesn't. That's how people become upside down, owing more than the car is worth. If the car gets totaled or needs to be replaced, that gap can become a financial trapdoor. And here comes the third scenario, the one that looks the happiest at first. Someone gets a great deal on a new car because the monthly payment is only a little more than used. It smells like new plastic and possibility. It's reliable, it has a warranty. It feels like choosing stability. But the loan is long, the payment is steady, and suddenly your 20s are scheduled. You don't just have a car, you have a fixed monthly obligation that follows you into job changes, roommate changes, breakups, moves, emergencies. This is the part nobody says out loud. A car payment can quietly decide what risks you're allowed to take. That dream internship across town, the pay is low, the experience is high, but the payment is due. That idea to go back to school, tuition plus a car payment feels like trying to breathe underwater. The freedom you wanted starts to look like a leash. And here's the surprising reversal. The problem isn't the car. It's the mismatch between a short-term need and a long-term contract. You need transportation now. The contract demands stability for years. That's why financing a first vehicle can feel like stepping on a moving walkway that speeds up when you're already tired. We can zoom out and see the bigger picture. Americans carry enormous auto loan balances as a country. LendingTree reported total outstanding auto loan debt around $1.655 trillion in the third quarter of 2025. That number isn't meant to scare you. It's meant to show you this isn't a niche problem. It's a normal problem, so normal that it becomes invisible. And when something becomes normal, people stop warning you about it. They just hand you the key fob and say, "Congrats." Meanwhile, delinquency data hints at the strain. Public data trackers drawing from Federal Reserve/NY Fed sources have shown auto loans 90-plus days delinquent, hovering around 5% in late 2025. That's not destiny, it's a signal. Some people are being squeezed, and the squeeze can be the hardest when you're new. Now, if this is opening your mind, hit like, because now we turn the corner. Not into never finance a car, not into shame, into a calmer, more realistic question. How do you get the freedom without buying the trap? Start with the key fob moment. That moment is supposed to be, but you don't want to make a multi-year decision while you're emotionally high on independence, so you slow it down. You force your brain back into total cost, not because you're trying to be perfect, because totals tell the truth that monthly payments hide. When a dealer asks what monthly payment you want, you gently refuse the frame. You talk about the price of the car, the interest rate, and the length of the loan. When those are clear, the monthly payment becomes a result, not a trick. And you make the car compete with your actual life, not your dream life, your real life. If you're young, insurance might be the loudest cost in the room, so before you fall in love with a model, you get an insurance quote. It's not fun, it's not cinematic, but it's the difference between "I can afford this" and "I'm one surprise away from panic." Then you look at the loan term like it's a weather forecast. The longer it is, the more storms you agree to drive through. Long terms can lower monthly payments, but they also keep you paying while the car ages, while your needs change, while your priorities evolve. The goal isn't to suffer with a huge payment. The goal is to avoid financing a lifestyle you haven't grown into yet. Down payments help the same way umbrellas help. They don't stop the rain, but they keep you from getting soaked. A modest down payment reduces the loan, which reduces interest, which reduces the risk of being upside down. Even a modest down payment can change the whole deal. And if you need a cosigner, you treat it like what it is: shared risk. You don't just say thanks, you make a plan that protects them. Automatic payments, a separate savings buffer, a clear agreement about what happens if you lose a job or your hours get cut. Not because you expect disaster, because the adult co-signing you deserves the peace of knowing you've thought it through. You also shop for financing the same way you'd shop for the car. You compare. You get pre-approved if you can. It gives you leverage and clarity. It turns the dealership into a place where you buy a vehicle, not a place where you discover what money costs. And then, the most emotionally difficult move of all, you choose boring on purpose. A first car doesn't have to be the forever car. It's a tool, a bridge, a starter home on wheels. Boring looks like a reliable used sedan with a clean inspection. Boring looks like a model that's cheap to insure. Boring looks like a payment you could handle even if your hours drop for a month. Boring looks like leaving room in your life for growth. Because the real flex isn't driving something that impresses strangers at a red light. The real flex is owning your options. There's a quiet moment I want you to picture near the end of this story. It's a Tuesday. Not a special day, just a regular day. You're sitting in your car with the engine off, hands on the steering wheel, looking at a notification that says your payment went through. And instead of dread, you feel nothing. Not panic, not relief, just calm. That calm is what affordable really means. And it's available, not through hacks, through alignment, matching the car to the season of life you're actually in. So yes, financing a first vehicle can suck. It can feel like the world's most expensive rite of passage. It can turn the key fob from a symbol of freedom into a tiny reminder of obligation. But it can also become your first lesson in how money really works. Incentives, contracts, psychology, and the power of slowing down when everyone else wants you to rush. If you want more calm, documentary-style money stories like this, stories that respect your brain and your reality, consider subscribing. And I'm curious, what part of financing a first vehicle feels the most stressful to you right now? The payments, the insurance, the fear of repairs, or the pressure to get something nice?